Well, good evening. I have lost bonus chapter A, and so what I'm going to do, I've had some difficulty here tonight, as I normally do, and I apologize for that. We're going to go to bonus chapter C, which is managing risk, as you can see. We will then go to bonus chapter D, which is managing personal finances. We'll take a break. I'll get the bonus chapter A back up, and then we'll go to that. I have to get out of the where I am now to be able to do that. So the learning goals for this chapter, as you can see, are identify the environmental changes that have made risk management important, explain the 4 ways of managing risk and distinguishing between insurable and uninsurable risk, define insurance policies and explain the law of large numbers and rule of indemnity, and then finally discuss the various types of insurance businesses can buy to manage risk. The goals of enterprise risk management, also known here, as you can see, as ERM, is defining which risks the program is going to manage, what risk management processes, technologies, and investments will be required, pardon me, and then how risk management efforts will be coordinated across the firm. What is risk? I think the simplest way to explain risk is, besides what you have here on the slide, is understanding that there's a chance of loss of anything. Now, risk can be entering a game, it can be running a business, it can be insuring your home, your life, etc. The best way to explain this is to ameliorate the risk. So to lessen the risk, in some cases, depending upon how you do this, to spread the risk out far enough so that it's very manageable and the risk is rather thin. Or in the case of some things like life insurance, etc., it is saying what's going to happen, what's the risk if I am not here. Well, let's not talk about death, let's talk about incapacity. This would be a risk for supposing you're a small business owner, that you wouldn't be able to work for a period of time due to some type of injury or illness. So you'd have this kind of risk type insurance. And what it's going to do is it's going to allow you to have some money coming in while the business itself is not being operated as well. Speculative risk and pure risk, two different things. Pure risk is you don't have any chance of recovering any loss, or speculative risk, as the slide says, is the possibility of either having loss or profit. How do we deal with pure risk? Well, the first thing is to reduce the risk. So it could be something as simple as getting yourself out of the risk environment. So whatever that happens to be, removing yourself from that equation so you're not facing a risk. And then that's obviously goes to the second point of avoiding the risk. But also, if you are doing things to stay away from the risk, then you're reducing the chance of risk. Obviously, we've talked about this before, self-insuring against the risk. And then that's yourself now. That's self-insurance. Don't think of that as buying insurance. That's exactly what it says. It's self-insurance, and then buying insurance to against the potential of the risk. This particular slide is like I like to talk about a gee whiz slide. It talks about some of the risks that we have faced in the United States in the last few years, and other places like in Japan and Chile, etc. And then what year they occurred, and then the losses in billions of dollars. Now, one thing that is not on here is the large earthquake and tsunami that happened in Japan in 2011, 2012. I don't remember exactly. That was a severe type thing. And of course, in that particular situation, there probably were a number of businesses that simply could not get insurance for various and sundry reasons. Self-insurance is what this slide says, is that's putting away money or some other type of asset that can be turned into liquid money asset fairly quickly to hedge against any type of risk that's going to come on, a potential catastrophe, etc. And now this next thing it goes on to explain this this self-insurance is only buying insurance for catastrophic occurrences. And so it talks about big losses. You would want to talk to someone who's in the insurance business and discuss with him or her what you're going to do. You may want to talk with a financial planner or a number of other people to discuss risk, how you can ameliorate risk, and how you can address that through a combination of self-insurance and buying insurances. Notice here what it says is the companies, now this is usually talking about larger companies than mom and pop shops or partnerships, which we consider to be very small companies for the most part, not necessarily all the time, but most of the time they are. Notice they go bare and they pay any kind of claims and indemnity claims out of their operating funds. Now, they could also set funds aside and say those are not operating funds, that those funds are set aside specifically to address claims, malpractice claims, for instance, or shoddy merchandise, or things of that nature. Now, this particular slide asks you what risks are not insurable. These are risks that no insurance company will underwrite. Now, here are some of the ones they're talking about. Market risk. Now, let's explain this. When we had the Depression in 1929, we had the quick stock market crash, rebounded fairly quickly thereafter in 1987. Then when we had the recession that we're just getting out of, it started in late 2007 or 2008. Insurance companies will not insure anything like that. Now, you can insure yourself against potential damages or some other type of potential loss, but not something like that. Political risk, which is normally talking about some change in a government somewhere, and nobody's going to insure that. Personal risks and then operational risks. This slide is a little bit better slide. Talks about a little bit better news here in a way. What risks are insurable? In other words, where could you go to an insurance company that's in the business for doing this to be able to buy insurance to cover a potential risk? Now, what it says here is that the person seeking to buy the insurance has to have something that's insurable. Now, we're not, in this particular case, we're not talking about life insurance. We're talking about property for the most part. Whatever loss there is has to be measurable. Whatever potential loss there is has to be measurable. The chance of loss must also be measurable. So they need to figure out what it is, and there are actuarial tables that they have to do that. The loss has to be accidental. So now we're talking about something like a storm damage, fire damage, or something of that nature. The insurance company, if it is going to insure you, wants to make sure that you're part of a broad base of people being insured for similar type situations. So it is spreading the risk out over a number of different companies, concerns, organizations, whatever it is. And then the insurance company can set the standards for accepting the risk. And they'll say, well, we will accept this type of risk, we won't accept that type of risk. These are various types of insurance policies that we're going to talk about. Remember that an insurance policy is a contract that's entered into between the issuing company, here would be the insurance company, and an individual. And the insurance company is going to promise to pay for a consideration, which we will get to in a second, damages that you incurred for loss from the risk. Now, notice it says it promises to pay all or part. This is something that you need to, when you're getting the coverage, understand and make sure it's adequately explained to you. If there's any change to the policy, make sure you read it. Go back to your insurance broker and ask him or her what's changed. The premium, we said for consideration, that's the fee that is charged by the insurance company to you to provide you that coverage. And that's usually an annual premium. Some companies will let you pay them semi-annually. Some will let them you pay them monthly. Some of the monthly ones I have seen, that's an automatic deduction from your checking account. Now, what you need to do when you're paying this premium is look at the premium and see what the cost is. Normally speaking, if you pay the premium once a year, it is less expensive by some measurement than if you pay it semi-annually or you have this automatic deduction 12 times a year from your checking account. A claim, this is what you would send to the insurance company and said, I had this loss because of this event, and based upon my contract with you, my insurance contract with you, this is what you owe. And of course, as it says, the last thing there, you're requesting payment. Now, insurance companies work on the law of large numbers. They want as many people as possible in this pool so they can spread it out over a period of years. Now, for instance, my wife and I just received notification from our insurance company that covers our house and other things in there that our premium was going up for I think it was for flood insurance. I can't remember what it was. And so we sent the company a note and say, wait a minute, this doesn't apply to us. We didn't, we have no claims, et cetera, et cetera, et cetera. They came back to us and said, yeah, but you live in the state of Kentucky, which we do, and there were a large amount of claims for this last year. And as a result, so we don't lose money, insurance company, we have to raise your premium. And then notice that what it says here is that the insurance company, and of course, all insurance companies have this information, that there's a predictable number of losses over a given period of time, what they're going to have to pay out. Rule of indemnity, an insured person or organization cannot collect more than the actual loss. A couple different types of insurance companies. There's a stock insurance company, and there's a mutual insurance company, mutual owned by the policyholders. In other words, the company is owned by the policyholders. A stock insurance company is owned by stockholders, just like any other company that issues stock. This particular slide just tells you some stock insurance companies you may have heard of. Metropolitan Life, most people have heard of that. Prudential Life was another. Mutual insurance companies, New York Life, Northwestern Mutual, and Massachusetts Mutual. Health insurance, a big issue, probably becoming an even bigger issue since we have the Affordable Care Act, and that will continue to play out over a period of times. Of course, as you know, with the Affordable Care Act, there is an amount of politics involved in that, so we'll just have to see how that plays out. And it's what this slide says. It's still ongoing. The Affordable Care Act has been the law of the land since it was enacted in 2010. It was not intended to go into force until 2014. There are a number of reasons for that. Most of those are based upon not only the government, but businesses, et cetera. It's not one of these things that you can turn something on immediately. And of course, it's gone through several challenges to the United States Supreme Court. Some provisions of it are still being challenged. One case was heard just recently, so we'll have to see how that plays out. We'll also have to see how the rest of it plays out. So really not much we can talk about here other than to say we do have a law. It has been implemented. It is starting now. There's roughly 8 million people enrolled through the Affordable Care Act. Many of them did not have insurance before that. Ability to enroll will start again in either September or October this year. These are some employer health options. I'm not going to speak a whole lot about these, but what it does say to you is if you do receive insurance from your employer, you need to find out what type of plan they have. A health maintenance organization, preferred provider, and then health savings account. Health maintenance, HMO, full range of health care benefits, and of course it emphasizes on preventative care. And notice that there's a restricted list of physicians. The PPOs, preferred provider organizations, will contract with hospitals and physicians. If you're in this type of plan, you will usually pay some part of the bill, and you do have the opportunity to choose your physician within a given list. Health savings accounts have gotten a lot of traction these days. This is, they usually are, they're tax-deferred savings. Your company has to set that up. And notice it says they're linked at low cost. You may have a rather high out-of-pocket deductible to pay. So that's something you need to consider. The thing about it is tax deferred, and when you pay into that, that actually decreases the amount of money that you're paying. So you don't pay tax on that. So it is an advantage. You don't pay tax on it. You don't pay tax now. You don't pay tax at the end of the year. So it does reduce your taxable earnings by the amount of money that you use for this health savings account. But again, it's something that you have to look into. You probably won't have a choice if that's what your employer offers, but you may have a choice of doing a few things within the program. Other types of insurance we talk about are disability insurance. That replaces part of your income. Sometimes it comes through workers' compensation, which is part of that. And the workers' compensation, of course, is a little different. Disability insurance is something normally a person buys, but workers' compensation does have a disability rider to it, for lack of a better term, and so that will do that. Well, here's actually some health tips here. If you're going to buy any type of insurance, especially if it's related to your health or to your longevity, life insurance, it's to your benefit to be as healthy as possible. Now, what happens here when you buy life insurance? And I'm not telling anybody not to buy life insurance. What I'm saying is this is what happens. You're betting the company that you're going to die, and the company's going to have to pay that benefit. The company, on the other hand, says we have actuarial tables that say that you aren't going to die, and we'll take that risk. So look at the type of insurance you're buying. Make sure that you buy something that will cover what you want covered, and it will not cost you several arms and several legs to pay on a routine basis. And that's what that second bullet said. The third one is pick a good insurance company. I cannot give you any advice on that. What the advice I can give you is to research what you're going to talk to someone that you trust. And that's the last piece here. It talks about finding a good financial planner. Liability insurance is something that professionals buy because they are frequently sued for negligence, also known as malpractice, or can be known as malpractice. And so they will buy this to help stave off having to pay large amounts of money out of their own pocket. Home-based businesses, you must be careful with a home-based business because your homeowner's policy will normally not pay for loss that's associated with your business. So you need to find out about that if you have a home-based business and you have a certain section of your house or your apartment, wherever you're residing, set aside for your business. You need to make sure that the insurance that you have through your carrier will pay for any loss, like if you have a fax machine or a copy machine or things of that nature. If they won't, then you need to buy business insurance. Or, as it's noted here, a rider to your insurance policy. And then here's Home Matters. Just remember that what this is going on about here, what we just repeated, the first bullet. The second one is don't buy too much coverage. Only buy what you need. And figure your replacement costs. That's the amount of insurance that you need to buy. I can't do that. Didn't think so. And then remember that small claims will add up. If you have a lot of small claims, that will most likely increase your premium. So you need to think about that. And then talking about homes, that home's history matters, its construction matters. So you need to think of all of those things. That brings us to the end of bonus chapter C. We'll now get into bonus chapter D, which is managing personal finances. The learning goals for this bonus chapter, we're going to talk about the 6 steps of controlling your assets, explain how to build a financial base, including investing in real estate, saving money, and managing credit, which is always a big issue. Look at how buying appropriate insurance can protect your financial base, kind of going back to the last chapter, which is going to make some additional points here. Pardon me. And then outline a strategy for retiring with enough money to last a lifetime. This is something that's very, very important to pay attention to. Too many people do not have adequate retirement savings. And it's not something that's, excuse the expression, going to fall out of the tree. Notice it says here that financial planning begins with making money. I would like to change that and say that financial planning begins with having a plan to help you make money. Having a plan is not going to make money. You have to have a plan. Think of that as a roadmap of telling you how to get from where you are to where you want to be in whatever period of years that you want to get there, and have the amount of money that you need to have so you can live comfortably for the remainder of your life. Notice here that education pays a lot here, although education is coming under some scrutiny today. But normally speaking, a person with a 4-year degree earns about $50,000 more, 62% more than a person with a high school diploma. I think that's probably a little off there. I'm not so sure I agree with that. I think that figure is higher when it's spread over an entire working period of 30 or 40 years. Notice here the lifetime earnings. This is more appropriate down here at the bottom. That a lifetime earnings for a family with a bachelor's degree or with bachelor's degrees will be about $1.6 million more than a family who has a high school degree. These are the 6 steps that the authors say that you need to take to control your finances. First is find out what you have and your assets, financial assets. Remember, you need to include things that you could, if you had to, sell to turn into money. Those are assets. Know how much you spend. What it costs you. We're talking here about your rent or mortgage, your utilities, etc. Food expenses go into that. And then everything else you need to think about. If you had an automobile, how much that costs you, gasoline, etc. So those are all expenses. You need to know what your expenses are. Prepare a budget. Now, what I like to talk about when you prepare a budget is to prepare a budget to make it so where you know exactly what you have coming in and exactly what you have going out. And then you know what that buffer is, so that if there's some extraordinary expense that comes in, you have an ability to adjust to that. Notice here it says pay off your debts. One of the biggest things that you should do is, if you have a credit card debt, is to pay it off as quickly as possible. Many years ago, this is at least 20 years ago, maybe a little bit more than 20 years ago, I used to listen to a financial program was on Saturdays, and I remember the person that talked about it mentioned that if you had $1,000 on your $1,000 bill on your credit card, and you paid a minimum amount due each month, no more and no less, just the minimum amount, and assuming you didn't run up any other debt on a credit card, it would take you 8 years to pay off that $1,000. So you need to think about that. It's very expensive with credit card. And you have to remember, when you use a credit card, the credit card company, usually a bank, is loaning you money, and you have to pay that loan off. And the typical monthly interest on those is anywhere from 18 to 23%, can be a little bit higher. The best thing for you to do is to pay it off as soon as the bill comes due. Start a savings plan. And then notice here the last thing, borrow only to buy assets that will appreciate over time. That's why people talk about buying a home. Homes tend to, and listen to the word I used here, tend. They tend to appreciate over time. That is not always true. Sometimes we have a real estate devaluation or stagnation. But normally speaking, a home is a good investment, and it will appreciate over time. Now you have to remember something. Homes take upkeep. They have to be, you have to paint them, you have to take care of the maintenance, you may have to put in a new furnace, air conditioner, things of that nature. Those will add to the home's value over a period of time, as long as they're fairly recent. You may have to put on a new roof, etc. So homes don't come without things that you have to do to keep them in good condition. But normally speaking, they do appreciate over a period of time. Now, this particular slide talks about managing your budget. These are the expenses that you normally have. I don't need to go through those. They're normal. There's nothing out of the ordinary there. Are monthly expenses, and you need to remember that you cannot be spending more than you're taking in. So if you have that on your plate, something has to go, and you have to figure out what that is. Now this is just another one of the gee whiz slides that I like to talk about, how you can save money by giving up some things that are not absolutely necessary. Just look at what you would save over a month, and it will save you an appreciable amount of cost. Now, it talked about money. One of the things we have to be about saving money, that is, one of the things we have to be concerned about right now is that you cannot, like you used to be able to, go to the bank and put a good deal of money in the bank and get a fair rate of return. It used to be you could get, when I was younger, it was 3%, and it went up to 6%, and it stayed there. Banks sometimes a little bit less, a little bit more, for a long period of time. Now it's down to really a pittance. So you have to decide where you want to put your money so it's going to give you the best possible return. Remember, we talked before last week about using the stock market. The stock market is speculative. Nothing that you buy on the stock market is government insured. There's no FDIC insurance with buying stocks. But you can buy stocks that have a fairly good value, that have a good track record and are most likely going to continue that track record. So you have to decide, this is part of that risk thing. How much am I willing to risk? If you don't want to risk anything, then you need to use a bank, a savings and loan, or a credit union if those are available to you, and understand that your rate of return is not going to be that great. But what is good is that you're saving, and that your saving will grow over a period of time. Banks, savings and loans, credit unions, the return is not going to be that great, but you are going to get a return. This particular slide talks about easy ways to cut budgets, cut back on gourmet, cut down on your cell phone bill, or find a different provider that gives you a better avenue of return, meaning that you're not going to be paying as much as you want. Cut out cable television. That's pretty difficult for most people. My wife and I don't have cable. We have DirecTV, and I always complain that there's never anything on. Of course, I don't watch a lot of television, but besides, what I'm saying to you is think about how much you could save. Now, yeah, you can still get channels, maybe not the channels you want, but you can still get them. Just think about what is important to you. And there's some other things there that are just as easy to talk about. This particular slide is just a gee whiz slide. I'm not going to get into it. It's there if you want to look at it. It's fine. It is posted for week 8, but it's not something I'm going to discuss. Now, this particular slide does talk about something that is important to all of us, and that's building your financial base. If you are married and your spouse works, try your best to live on one salary and invest the other salary. That's always best if you can do that. It's difficult, I realize, but it's best. If you want to get into an investment, buy a home with a low mortgage rate, something like it's called, it used to be called quite often, you don't hear as much anymore, a fixer-upper. And that way you can get something that you could put a little work into it, a little material into it, etc., and then sell it for a profit in a year or two. One of the things to tell you, however, is the old rule of thumb about buying a house and selling it is that you should own a house for a minimum of 3 years to get your investment out. As here, buy for the long term and don't live beyond your means. Certainly don't live beyond your means. These are some rules for frugality that the authors provide us. First of all, notice what it says there. Don't give up something that you really like. But do some other things. Find things that are inexpensive forms of entertainment. Don't go out and buy things that you don't need. Stay with essentials. You know, when you're working for someone, I want to put it that way so we can make it a little easier to talk about. You get a paycheck at the end of a week or every 2 weeks, which is probably more common. Some are monthly. And you pay your taxes. The taxes come out of that. And then you have X number of dollars that you take home. And then from those X number of dollars, you have your expenses. And once you're finished with your expenses, you have some money left. Now, you can do one of two things with that money. You can save it or you can spend it. You can't do both. Now, yeah, somebody say, okay, well, I'm going to save half and spend half. That's fine, but you're still spending some of it, and you're saving some of it. So you really have to think about this. Okay, you're not doing both because you split it in half and said, now this half I'm going to save and that half I'm going to spend. Uh, and then notice here it says never go shopping without knowing what you want to buy. Now, there's a problem with that. And I like to say this, that men are buyers and women are shoppers. Now, that's not meant to be pejorative. Women like to shop. I know some men that like to shop too. I'm not one of those people. I walk in the store, I have a pretty good idea what I'm there for and what I'm going to buy. And if they don't have it, I'm going to leave. But people do shop, and they look around, and shopping does not necessarily equate with buying. And we can do a lot of shopping online today. So you don't even have to leave your home if you have an idea what you're looking for. So shopping is comparing. Now, what this actually says, at least to me, is don't go in someplace without having an idea of what you want to buy. I'm going to talk about shopping. I think it's a different scenario here, and I would argue with the authors about that. And then shop around for good deals. Well, that's what we were talking about. Use the internet. Use whatever you know, newspapers, whatever type of advertisement you get to compare, because you need to do that. Here's the financial benefits of buying a home. It's an investment. Remember that. It's something that you can live in as an investment. Talks about paying for a home is a good way to force yourself to save. And I would agree with that. I don't think we think of that right off the bat, but that is true. The interest that you pay on your mortgage is tax deductible. There's been a number of movements afoot over a period of years to take that away, but that's not happened, and it's not going to happen, at least not in the foreseeable future. That will stay. And then make sure when you buy something, a piece of property like this, that you get the right location. That's important. It says location, location, location. Some things you should investigate. Am I buying a home that's in a good school district? That's an important thing, that people will like to move to good school districts so their children can go there. They can benefit from that. Even if your children don't go to those schools, the community normally benefits from a better school system. How much house can you afford? This talks about what your income is, what your monthly payment is, and then what the interest rate is, how much it would take you out over a period of years. You need to make sure that you do that. You should not spend more than a third of your take-home pay on either rent or a mortgage payment. Savings and managing credit, the contrarian approach is, this is talking about buy stock. Buy stock when everybody else is selling, or the reverse. Everybody else is buying, you may want to consider selling. Everybody else is selling, you may want to consider buying. Credit cards are great to have. Remember what I said before. If you use them, you're actually asking for a loan, which must be repaid. Make sure that you check the credit card that you have and understand what its terms are. You can shop around from those. There's a number. There used to be a number of credit card companies out in the Midwest. South Dakota was one state. I cannot tell you the bank because I don't remember it. Had a pretty good rate on credit cards. Have to be careful about this. You're in college, look at your student loan, etc. Just make sure that you know what that is so you don't get sticker shock. If you are taking loans, college loans, and you get a disbursement, remember not to spend that money because a refund, because you may have to have that money later on down the road. So you're better off putting that in the bank and saving it. There's the Credit Card Act of 2009, which says that your and insures to increase interest rates for only a limited number of reasons that the insurance companies can do. Of course, they found ways around that, so you just have to be careful about that. People must be over 21 or have an adult as a co-signer. This is just another gee whiz slide. Talks about how much credit card debt we have. Not something I want to talk about, but it is a serious problem. Don't add to it if you don't have to. This is something that's called clean credit. How to make your credit clean, pay your bills on time. It says here keep small balances on multiple cards. I would tell you keep no balance. Don't shift balances, because even though you get this come on that they're going to save you a little bit of money, it's probably not a good idea to do that. Don't file for bankruptcy unless you absolutely have to. Ways to buy insurance. Term insurance. Notice the term I use there is pure insurance, but it only covers for a certain amount of time. But it costs a lot less, and it costs you a lot less to buy when you're younger. It's just a cheaper way of insurance. If you're going to buy insurance, make sure you get an insurance agent who will explain all these things to you and look at your options. Don't buy anything more than what you have to buy. Whole insurance, there's combines life insurance with the savings plan. So you're getting both insurance and savings. That can be something that's positive to you. Just remember that you're not going to be able to cash in on that for a number of years. You're always able to cash in on it, but you won't get back what you would like to get back. Variable life insurance. I'm not going to talk about this too much. If you're interested in it, get an agent that you trust to explain it to you. This is the same thing with annuities. This is the contract to pay regular amounts of money to a person over a period of years or a fixed period, life or a fixed period. It kind of guarantees an income. Two types, fixed and variable. Other types of insurance policy we talked about. We've talked about disability before. We know about homeowners insurance. There is renter's insurance available, but you need to talk about it. Everything that's covered in homeowners insurance is not always covered in renter's insurance. Again, ask somebody, make sure you get good information. And then an umbrella policy is exactly what it says. It covers a number of different things. Question asked here is who pays for health care? A gee whiz slide, which we really don't have to go into too much. And this is where the health care money goes. Again, I'm not going to talk about that to a great extent. You have to learn about health savings accounts. Remember, we talked about those in the last bonus chapter. If your employer has these, find out about them. Remember that they can be costly. The plans can be costly, but withdrawal for medical bills is tax-free. Remember, they're not for everyone. And find out about them and make sure that if you do get into this, that somebody explains it to you so you understand it. Blast it. Sorry about that. Social Security, we know that that's what you pay if you work for someone. It comes out of your tax. It's FICA. Originally known as the Old Age Survivors and Disability Insurance Program, established in 1935. A lot of stories about Social Security. I'm not here to add to them. What I'm here to tell you is that it was never meant to be a retirement from that you paid into. It was meant to be a subsistence to that. So don't look at that as something that you're going to use to retire on. It will help you retire, yes, but it's not something that you should count on. IRAs, these are tax deferred. If you can get them, you can get them through your company, and you have to, again, it's one of these things you have to check into, find out about it. The amount of money that you pay into these are tax deferred, means you do not pay tax on it at the time you are investing in an IRA, but you will pay tax on it on the way out when you withdraw. Now, a Roth IRA is different. There is no tax on a Roth IRA from beginning to end. (401k) plans, that is a type of IRA. And this is sponsored by your employer, and the employer can match up to a certain amount of money. And again, if you're contributing to that, that money is the money you're contributing is tax deferred. You only have to pay when you take the money out. And one thing I will tell you now is you have to begin withdrawing at 70 and a half. Here's the benefits of what you invest is tax deferred, so it reduces your present income tax amount due. It's deferred on the earnings, and then again, many employers do match. A Kehoe plan is similar to an IRA, but it is for self-employed people. And it can be withdrawn in lump sum or spread out over a period of years, just like a traditional IRA can be done that way too. It's just a little bit different. And then you can plan for inheritance. You should have a will. Everybody should have a will. That doesn't cost a lot of money to have those drawn up. That keeps squabbles down, etc. So you can do that. And then someone to execute the will, known as an executor. And that brings us to the end of bonus chapter D. And as I mentioned, I'm going to stop this and we will come back again in a few minutes, and I'll have in 10 minutes and I'll have bonus chapter A. Somehow I lost that. I really don't know what happened. We'll try to get that back. So we can do that as well. I don't know where it went. The gremlin took it. So we'll be back here. It's 5:32, just 5:33. I'll be back here at 5:40, and we'll do a chapter A. So thank you for your attendance, and I look forward to talking with you again in about 7 minutes. Thank you.